Okay, I hope I'm audible to all my students who are attending this particular lesson for the Cambridge International AS Economics course. In this particular lesson, I'm going to start with the first module within the macroeconomy. This is national income statistics. Okay, so from this lesson onwards, formally, I am starting with the macroeconomy module. Okay, it has several chapters. We are going to start with the first chapter within the macroeconomy. This is national income statistics. Okay, we are going to first of all discuss about some important terminologies which we use in the national income statistics. Okay, so it's going to be a very interesting lesson. All students who are attending this online lesson, you are requested to make notes because they are going to be immensely helpful in your revisions for the final exam. Okay, so let's quickly start with the discussion of national income statistics concept in this particular lesson. So I'm just writing the main heading for completeness. We are starting formally with within the Cambridge International Education AS Economics. We are formally starting with the macroeconomy module. The macroeconomy. And within this, we are starting with the first chapter within this module. This is national income statistics. National income statistics. So first of all, let's understand what is meant by national income. Obviously, when you talk about the income of the whole economy, okay, or when you talk about the output produced, the total output produced in the economy, that is nothing but national income. So I can first of all write that national income, national income measures a country's total output. National income measures a country's total output. Okay. Now, whenever the output is produced in the economy, it also generates income because when output is produced, people also buy it. So I can say that whatever output is produced generates an equivalent amount of income. Okay. And that income, which is received by the producers, should match the expenditure done by the households because households do expenditure, which is nothing but income for the firms. So I can write that people earn an income from producing the output. People earn an income from producing the output. This income is then spent on the output. So when the output is produced in the economy, those who have produced this output, these are nothing but the factors of production. Remember, we had covered factors of production in the microeconomics module: land, labor, capital, and entrepreneurship skills. When these factors of production produce output, they are rewarded. That means factors of production like land earn rent, labor is going to earn wage, capital is going to earn interest on it, the entrepreneur gets the profits. That means whatever output is produced generates income for all the factors of production, and then this income is then spent on buying that output. Whatever income will be earned by the households in the form of rent, wages, interest, or profits, households will do. What will the households do with this income? Households are going to use this income to buy goods. So this income is then spent on the output. This means what? This means that This means that total output should equal total income and total expenditure. Total output should equal total income and total expenditure. Okay, so what I'm trying to say is whatever output is produced is going to generate income. So I can draw a flow chart like this. Output generates income. In the bracket, I can write this income is rent plus wages plus interest plus profits. It generates income for the factors of production who have produced this output. And then this income received by the factors of production, this income is then spent on buying the output. So in a way, total output, total income, and this is nothing but total expenditure. When you are spending your income in buying the output, this is nothing but expenditure. This is expenditure. So total output, total income, and total expenditure according to the national income statistics should be equal. Okay, this is what I'm trying to say. And we use output in macroeconomics. We often use output to capture the standard of living of the people. So I can erase the initial portion off and I can write here on the top as a note. Within the note point 1, higher output has the potential to increase the standard of living of the people. Higher output has the potential to increase the standard of living of the people. Okay, so this is one thing. The second important point to understand is when you're going to measure national income, it is measured with respect to time. So I can say that national income is a flow concept. National income is a flow concept as it is measured with respect to time. It is measured with respect to time. So I can write that national income is measured each year. Let me erase this paragraph off and then I can continue. National income is measured each year and compared both in the short run and the long run. It is compared both in the short run and the long. Okay, so these are two important points of note for us to understand. Remember, a variable is a stock variable if you measure it at a point of time, but a variable is a flow variable if it is measured over a period of time or with respect to time. That means it has a time dimension. National income is a flow concept. Economies measure their national income annually every year and they compare their national incomes in the present to their incomes in the last year or the last 10 years or the last 20 years, last 50 years, and so on. That means when you are measuring some variable with respect to time, you can make intertemporal comparisons. You can compare that variable across time. So I hope so far students are clear. Now let's understand within national income statistics. Now let us understand. Let's first of all understand what is national income statistic. We have talked about national income. Let's understand what is the national income statistic, and then I'm going to jump to the measures of it, like gross domestic product, gross national product, and so on. So students can now write national income statistic. National income statistics. Okay, so I can say that this is a general term for a number of measures. It is a general term for a number of measures of a country's economic activity. Number of measures of a country's economic activity in terms of its output, income, and expenditure. So when we talk about national income statistics, it is going to give us a number of measures to calculate the economic activity within a country. And how do we capture the economic activity, either in terms of the output produced in that country or income generated in that country or expenditure done by all the stakeholders, households, firms, government, etc. in that country. That means you measure economic activity in a country through three routes, either through output or through income or through expenditure. And the measures you are using to do all this are a part of national income statistics. Okay, so now let's look at the first national income statistic, which is very famously used, most widely used, called the gross domestic product. So let's look at gross domestic product. Very famously also called as GDP. Okay, so this is the most widely used. This is the most widely used measure of national income. It is the most widely used measure of national income. Okay, so I can say that GDP captures the market value of all the final goods and services produced within the domestic territory of the country, produced within the domestic territory of the country in a given accounting year. So when we talk about gross domestic product, it will capture the market value. Now there are two ways in which you can measure the value. You can either measure it at the market value or at the factor cost. Factor cost is just the cost of production. When you add taxes or subsidies or subtract subsidies to it, you get the market value. Because when any product is sold in the market, some taxes are applied to it, which will increase its price. Some subsidies will also be given by the government for supplying that product, which will decrease its price. So market value is nothing but the factor cost of producing any good. To that you add all the indirect taxes and you subtract all the subsidies, which gives you the market value. So I can in a way write here as a note that market value is just equal to the factor cost plus indirect taxes, because indirect taxes increase the price, minus subsidies, because when subsidies are given, it reduces the price. We have done all this in our lectures on government microeconomic intervention. When we were doing taxes and subsidies, remember my lessons on government microeconomic intervention, we had talked about taxes and subsidies, and we had learned that indirect taxes increase the price of the commodity in the market and subsidies lower the price of the commodity in the market. So GDP doesn't take into account factor cost. GDP takes into account market value of all the final. That means GDP doesn't talk about intermediate goods or goods in progress. It only talks about value of the final goods. So I can write the second point. GDP does not include the value of intermediate goods. GDP does not include the value of intermediate goods or raw materials or goods in progress. Why? This is because their value is automatically included in the final good. So if you're going to include the value of intermediate goods or raw materials, you are double counting. Okay, so when I talk about GDP, it only includes the final goods and services. It doesn't include the value of intermediate goods, because intermediate goods value is automatically included in the final good. So if I add intermediate good value again, I'm double counting it. So I can write this is done to avoid double counting. This is done to avoid double counting. Okay, so I hope students are all clear with both these points of note. Okay, and if I now move forward, so what is GDP used to assess? So the third point within the note, if I erase the initial portion of, I am writing the third point on the top, that GDP is used by economists, governments, and international organizations to assess what is produced, earned, and spent in an economy. So this is often very widely used by economists, the concept of GDP. It helps one to assess what is produced in the economy, the income earned and spent. Again, total output, total income, total expenditure. Okay, so hoping students have understood this. Now, let's understand what is gross national income. Let us understand what is meant by gross national income. So I'm erasing this portion off, and we are now looking at gross national income. Now let us see how is it different from GDP. Short form GNI. So gross national income is the income earned. Gross national income is the income earned by the country's residents, and firms, regardless of where it is earned. So when I talk about gross national income, it is nothing but the total income earned by the residents of our country. Now, it is not compulsory that the residents are in India. They might have gone abroad temporarily for some time. When you talk about GDP, the first question which should come to your mind is anything produced within the domestic territory of the country. When you talk about GNI, the first thing which should come to your mind is whether it is produced by the residents of the country or not. It may be within the domestic borders, it may be outside the domestic borders, but it should be produced by the residents of the country. It should be the income which belongs to the residents of the country. Okay, so hoping students have understood this, I can further write that GNI includes the net property income from abroad. It includes the net property income from abroad. When I say net property income, it means, let's say we are talking about the net property income of an economy, let's say India. Then the Indians who own properties abroad, the income they are earning from those properties, minus foreigners are also owning some properties in India. So the rent they are receiving on properties they own in India. So when I say net means what? Net simply means income earned by the residents of India from properties owned abroad minus income paid to the foreigners owning properties in India. Okay, so GNI includes net property income from abroad. It also includes other sources of income. It also includes other sources of income that residents receive from abroad. It also includes other sources of income that the residents receive from abroad, and it deducts other sources of income. It deducts other sources of income that the foreigners receive from the country. So all what I'm trying to say is when you talk about gross national income, it will only capture the income earned by the residents. You add all those incomes which the residents of the country are receiving. You subtract all those incomes which you are paying to the foreigners who are earning income in your country. Okay, it also includes, I can further erase the initial portion off and I can continue on the top. Erasing this portion off, I can further write that these payments, when I talk about these payments, I can write these payments are net receipts. These payments are the net receipts of compensation of employees. They are the net receipts of compensation of employees and net taxes less subsidies on products. Net taxes less subsidies on products. Compensation of employees captures what, guys? It captures the wages which the residents of India are earning abroad. There might be Indians working abroad, be it in foreign universities or be it in restaurants or be it in financial sectors. So whatever income residents of India are receiving from abroad in terms of the wages or in terms of the profits, compensation of employees basically includes wages. So Indians working in the corporate sector in foreign economies, let's say Indians working in American banks, Indians working in London banks. Okay, so whatever wages or whatever salaries Indians are receiving in a foreign land is a part of compensation of employees in this case, and it's a part of gross national income, because after all, Indians are all residents of India. The Indians working abroad are all residents of India, because their center of economic interest lies within India. Okay, so I can further write compensation of employees. Compensation of employees is wages earned by the workers. They are the wages earned by the workers who are residents in one country, but who work abroad for shorter periods. Who work abroad for shorter periods. That means they are not permanently going abroad. If an Indian permanently goes to US, he or she is no longer a resident of India. He will then become a resident of US. When you are going abroad only temporarily for shorter time periods, you are a resident of your own country and not the resident of the country you are going to. For example, if a professor from India goes to, let's say, US for 2-3 months for a project, for a research project, he or she is still a resident of India. But if a professor is recruited by a foreign university on a permanent basis, then he or she is no longer going to be a resident of India, but the resident of US. Okay, so I hope students are able to get sense of what I'm trying to say. So if I erase this off, I'm erasing this paragraph off now. I hope students have made notes. Erasing all this off. Okay, so basically these workers include what? These include seasonal and cross-border workers. These include basically seasonal or cross-border workers. They are going abroad only for a given season or for a given project. They're going to come back to their own country. Okay, so hoping students have understood this. So now let us look at what is meant by gross national disposable income. So now, after having looked at gross national income, we are now looking at gross national disposable income. Gross national disposable income. GNDI. The moment I use the word disposable, it means the income which is net of all taxes and transfer payments. So I can elaborate more on this. Gross national disposable income is the total amount of income available to a nation's residents after accounting for all the current transfer payments. After accounting for all the current transfer payments, like taxes, social contributions, and other payments to and from the rest of the world. To and from the rest of the world. So when you talk about gross national disposable income, you talk about the total income earned by the residents of the country. And to that, you are also accounting for all the transfer payments which have been made. That means all taxes which you are paying to the rest of the world and taxes you are getting from the rest of the world, social security contributions, all that is a part of disposable income. Okay, so I hope students are understanding the key difference. When you talk about gross national income, you don't take into account current transfer payments. But when you talk about gross national disposable income, the moment you have the word disposable, it takes into account, it also nets out all the current transfer payments. Okay, so hoping students have understood this. So now let's understand how GDP and GNI differ across countries. Okay, so I'm erasing all this off and I'm just drawing a flow chart just for perfect clarity. GDP versus GNI. Output produced within the domestic territory. Output produced within the domestic territory of a country. Now, domestic territory might include the political frontiers of the country. It will also include water bodies surrounding that up to some nautical miles. It will also include the airspace of that particular country, etc. GNI includes income earned by the residents of a country. Either within or outside the domestic territory. Either within or outside the domestic territory. And I'm making all students write a note. What is a resident? You should also know it perfectly in terms of the concept. A resident is that firm or individual whose center of economic interest, whose center of economic interest lies in that country or nation. Lies in that nation. That is, such a firm or individual carries out all economic activities. We all know the economic activities: production, consumption, investment, exchange, distribution, carries out all economic activities in that nation or country. So when you talk about an economic resident, that firm or that individual whose economic interest lies in that country. That means that that firm or individual will carry out production, consumption, investment, exchange, distribution within that country. That is called a resident. Remember, a resident may be different from a citizen. You are a citizen of a country if you are born in that country by birth, or if you have acquired a citizenship status. So citizenship is a nationality concept. If you are born in a country, you are automatically a citizen of that country. Or you can, through proper channels, also buy citizenship of a given country. But you are a resident of a country. If your center of economic interest lies in that country, you may not be a citizen of that country. It may be possible for an Indian to be a resident of US. That person might be born in India, that person might be a citizen of India, but just because that person has now permanently moved to US, that person now gets the residentship status in US, permanent residentship. Okay, that means you might be a citizen of one country, but you may turn out to be a resident of some other country. So citizenship and residency are two different concepts in economics. Okay, so hoping students have understood this as well. Now, if I talk about a few countries, you can see that their GDP and GNP might be different. So I can write differences in countries' GDP and GNI. Okay, so I can write that a number of countries, within this I can write point number one, a number of countries, including Ireland. Ireland is one such example of an economy which has a noticeable higher GDP, has a noticeably higher GDP than GNI. Now, countries where GDP is higher than GNI would mean that such countries attract a lot of foreign direct investment. That means a lot of output and income is generated within the domestic territory of an economy, but a lot of it doesn't belong to the residents. It has to be paid to the foreigners. Now, when a country receives a lot of FDI, you will see that that country will have a very high GDP, but GNI will be lower because ultimately that foreign direct investment is done by a foreign company in your economy. And whatever income is generated will be taken back to the parent company. So I can write this is because foreign multinational foreign multinational companies, also called MNCs, and foreign workers make an important contribution. They make an important contribution to the output of these countries. To the output of these countries. If you talk about Ireland, as the example we have taken, it attracts a lot of FDI. So I can say that a major reason for rapid rise in Ireland's GDP is its ability to attract foreign investment, but more foreign investment will also result in a net outflow of profits and other income, because whatever the foreign companies will produce in your economy will be routed back to their own home country. So I can further write that, however, foreign investment has also resulted in a net outflow of profits and other income. Has also resulted in a net outflow of profits and other income. So the whole paragraph, if I sum it up, economies, there are certain economies which have a higher GDP compared to GNI. Such economies like Ireland in the recent years attract a lot of foreign direct investment, because of which the production, the output, and the income generated within the economy is very high. But then it also means that a lot of profits and income is going to flow out, because the foreigners producing goods and services in my economy will ultimately take their profits and income back to their own economy. For such economies, GDP is higher than GNI. Now, let's look at the second point. Other countries have a higher GNI, gross national income, than GDP, because they receive a net inflow of property income from abroad. Now, there are some economies which own a lot of properties abroad, like German firms. If an economy owns a lot of properties abroad, the economy is going to receive rent from all those properties. Now, for such countries, GNI, the gross national income, will be higher than the GDP, because the output is not done within the territory, it's done outside the territory. The land is owned outside your economic territory, and you are getting income from that. Okay, so I can write German firms, for example. German firms, for example, have invested large amounts in other countries. They have invested large amounts in other countries in the past, and now receive an inflow. They now receive an inflow of profits from their multinational companies, especially automobiles. If you look at German is very well known in the market for its automobile production in other countries. Okay, so from their multinational companies operating in other countries. So students, what do we learn? We learn that if the GNI is higher than GDP, it means you have properties, or you have assets you own abroad and you receive income from them. And if you have a higher GDP compared to GNI, it means you have a lot of foreign direct investment in your country. Okay, so I stop in this particular lesson. What we have primarily covered in this lesson is we have been introduced to the concept of national income. We have talked about what is a national income statistic. We have talked about the fact that national income is a flow concept because you measure it across time periods. We have also learned that national income also kind of gives idea about the standard of living of people in a given country. We have talked about gross domestic product and gross national income as two important measures of national income statistics. We have also looked at the difference between them, where we have learned that gross domestic product is essentially the output produced within the domestic territory, whereas gross national income is the income generated by the residents of the country, either within or outside the domestic territory. And we have also talked about the fact that gross national disposable income is nothing but gross national income adjusted for current transfer payments like taxes, social security contributions, etc. We have also learned that countries with higher GDP than GNI have a higher level of FDI, and countries with a higher GNI compared to GDP have a lot of properties or income from properties they earn abroad. Okay, so in the next lesson, we are going to talk about methods of measuring GDP. We are going to talk about methods of measuring GDP. This is something I intend to touch upon in the next lesson. Okay, so all students who are watching my lessons, if you are keen on buying my complete course, you can get in touch with me. Okay, remember that to buy the complete course, you have to enroll on my app. So students who are watching my free lectures online, they are only a part of the complete course I offer. If you want to subscribe to my complete set of lectures for the Cambridge International AS Economics course, you can directly get in touch with me and I can explain you the procedure to buy the complete course. Because after all, it's only the complete course which will benefit you, not just a few free lectures. Okay. So I stop in this lesson. In the next lesson, we are going to discuss about methods of measuring GDP. So I stop in this lesson. I hope students have enjoyed this lesson. Any doubts, you can unmute your mics and ask, or you can get in touch with me for doubts on call or WhatsApp, or you can mail me your doubts at divineschoolof economics@gmail.com. This is where I stop in this lesson.